afternoon, everyone. Welcome. Some people are unicorns and some people are legends, and all three of these are both unicorns and legends. I'm really honored and humbled to have three of them here on this panel. You all know who they are, so rather than tell you who they are, I thought I would ask each of them to give me a really unusual fact about them that no one knows. So as we have our discussion, I want you to think about which person owns which fact. I'll give you the three facts now. So one of the panelists set up a book reading club with their kid, and the objective was to read 20 books a year. They actually achieved 22 books a year. One of my panelists lived with a Zulu family in South Africa and with a woman who grew up in Gandhi's ashram in India. And one of my panelists was profiled in a university newspaper at the age of 2 years old. So have a think who owns which fact. So as we turn to three of you, I'd like each of you to sort of describe yourselves with the labels that you would own and carry. And I'm going to start with you, Kim, because I've known you the longest.
Oh, interesting. And labels, how would I label myself? I'm a mother. That's probably the most important label I have. I am half Black and half Chinese, also important to me. I hope that I am a good friend. I hope that I am a compassionate boss. And I hope that one of these days somebody recognizes my rapping ability.
You can start today.
I have it on video. It's very good. Carlos?
Similar to Kim, I would start with family. So son, husband, father of three boys. And other labels, grew up in Mexico, born in the US, grew up in Mexico, came back to the US. So I would say an immigrant, an investor, a friend. Still working on the boss label, so one of these days.
Jenny?
Yeah, I've got to start with mom. And I'm Jewish, that's important to me. And then I would say I'm both a dreamer and an architect.
That is beautiful. So let's start off with the question that everyone asks. Is the endowment model dead? Who wants to take that first?
I'm happy
Jenny.
to Well, we chatted about this beforehand. I think of the endowment model as a set of first principles, which is really around how to generate a pretty high level of return in a durable way for institutions with infinite time horizons. And I think that's what everyone who runs an endowment, or in my case, a multifamily office with families that have semi-infinite time horizons, we're all still trying to achieve that. I think the problem maybe is that people got away from first principles into asset class definitions, and I think that's a lot more challenged.
I completely agree with Jenny. The only thing the caveat I would make is that I think it's very hard to follow first principles because we're human. And I think governance and people's managing of their careers, and yes, we manage capital that's infinite, but our time at our organizations are not infinite, nor the time of our governance structure is infinite. And so I think ideologically that's what we're doing, but in the reality, your board, your investment committee has an 8-year term, a 10-year term. They want it to look good during their period of time. You have whatever your career span is in your organization, and you want to look good during your period of time. And I think the natural rub and conflict makes it sometimes hard to do that, but the idea of it is exactly right, I think.
I would agree with what's been said. I would say also that I think different institutions have unique setups. So I would say that Yale with its reputation and endowment model, its ability to raise capital, David Swenson's reputation, had a unique ability to execute, where other organizations may not necessarily have that setup. And so I believe that some of the principles remain, the idea to rebalance, the idea to find undervalued assets, to have a long-term time horizon within all the constraints that were already listed out. And then that ability also to be a contrarian to a degree.
So you all talked about time horizon. How do you think about long-term time horizon today? Is it what it was 10, 20 years ago, or have you all had to be much more tactical around a long-term investment model now? Carlos?
So I think you want to have a long-term track record. That's what's most important, but you need to build it one good year at a time. Not all years will live up to that aspiration, but every year you should have. We try to be tactical with 1 to 5% of the portfolio in some things that have been very clear, and we have the advantage. We have over 550 meetings per year with managers to help inform us, a number of conferences that we may attend, research providers. And so when you have that vantage point and a team of 15 people that are thinking about the market globally every day, you should be able to hopefully identify opportunities that come up. And it may be something basic like interest rates going up in 2022 or perhaps going lower on the short term after that. Last year is an example of an implementation. We thought Chinese equities were inexpensive, and that's something we have done in the past, either on the long side or the short side. So I also believe endowments should think about shorting things. And so in this case, we thought the way we implemented that view was we looked at Chinese equities and expressed it via swaps, because the capital controls in China create mispricings or favorable pricing dynamics and derivative instruments. And so in that moment in time, back 1 year, Chinese hedge funds were buying were shorting a lot of baskets of Chinese stocks to be long short. And so that made the long side of the swap much more favorable if people decided to take that side of the swap. And so that was a way to express a favorable view on Chinese equities, but using derivatives as a way. So I think that our program is very long-term oriented. The foundation's been around for 96 years this year. We hope that it will continue to be around the next 100, and that we're not the cause for us to have to shrink the mission of the foundation. On the other hand, I think we need to make the most of all the elements we have at our disposal.
Amazing. Kim?
So we're a 275-year-old institution with the hopes of being a 500-year-old institution. We'll see what happens with higher education. But I think that unfortunately, we are long-term. I think we do try to think in a long-term way, despite what I said earlier. But I think the nature of the market is us hoping our managers are a little bit more tactical. Because I think the world is changing so fast, and things like AI and just the information flows are so fast that the advantages that many of our managers have are just shorter. The time frame that they work are shorter. And so we need managers who are able to pivot and able to take new information and make better decisions. And I think that, a lot of us have complained about the fact that the cycle in privates has extended by so much. So despite the fact that we're long-term, that's a problem. And I remember we used to have a lot of conversations about what a good asset class land was for many of us because it was so long-term. But it's a problem because we can't really invest in things that don't show any return for really extended periods of time. So I think that we hope to be as long as we can, but we need managers that are responsive to the world as it's changing. And I think at least not in my career, I don't remember a time that had this much change all at once. And so I think there is an expectation that we want people who are thinking about how those changes influence the ability to outperform as they evolve. And so it requires a little different skill set.
Yeah, what would I add to that? I guess at 45 years old, we're the baby in the room. There's a heavy consequence to us of making substantial changes in the portfolio, which is that we pay taxes. So every mistake, every change, every decision that leads to capital flows is costly. So we try to find the longest duration options when we can. One of the ways we look for that is in the actively managed portion of our long-only portfolio, saying, okay, this is a place where hopefully we can buy and hold businesses for the long term, and hopefully those businesses themselves are dynamic enough that a lot of the dynamism can happen behind the door where we're not paying for it. When we think more about alternative spaces, when we think about hedge funds broadly defined, I would agree with Kim, we're looking for a level of dynamism where we're just saying we're willing to accept some tax consequences for managers that can really lean in thematically, because it's very hard for us to do that ourselves. We can do it at the margin. We can, and I think part of it is, taking Chinese equities as an example, extraordinary performance last year. Everyone had given up on it a few years ago. People loved China a number of years back, and I think part of the sort of long duration thinking is just being able to stay put and lean in at the margin. So you don't have a new decision point, you have an incremental decision point that you're making. And I think the private side is really one of the biggest challenges. That's an area where my team for years was looking for long duration private companies that we could buy and hold, and how do we do that structurally? And it's been almost impossible to find because the economic incentives across the asset management industry are not long term. So there's just a massive misalignment of incentives.
You think you're going to start expressing those short-term interests, those tactical interests through swaps and ETFs and more passively going forward because it's just easier to do that? Or all of you, that's a question for all of you, rather than making a decision to invest in a manager?
I don't know that we're headed in that direction just because of how we're structured, but I do understand the appeal of it.
So we're risk allocators and not asset allocators. And so we, much in the same way as people rebalance back to the asset allocation, we rebalance back to the risk level that we set for ourselves. And often the way to do that is through things like ETFs and swaps and things of that nature. So we systematically use them to rebalance the portfolio, and sometimes we look at the construction of our portfolio and we say, okay, so we've picked the best managers that we can pick, but we have unintended bets in that portfolio because of the nature of the way they bet. It might be swayed in one direction or another, and that is not our belief overall. We believe in each of these managers, but we don't believe in that tilt. And so we will do something to rebalance back to a level that we think is appropriate for the organization. So we definitely use different types of strategies like that, just to make sure that we are, one of the things that we talk about as a team all the time is that there's no way to make money if you don't take bets, but none of them should be accidental. Every one of them should be because we believe that this adds value to the portfolio. And so we're always trying to figure out what bets we're taking that we didn't mean to take and rebalance back. So we use passive to do that oftentimes.
We'll use passive as well, similarly to what Kim does, either ETFs or derivatives. Occasionally, we will use baskets of ETFs or derivatives to express a view. That can be so a view will be 0 to 5% of the portfolio, and overall passive can be up to 10% of the portfolio.
So last decade, we've seen a lot of uncertainty. And when you think about that uncertainty, have you reduced your return expectations for the next decade going forward? And if so, I'm not going to ask you for exact numbers, but is it significant or is it just marginal? Jenny, do you want to?
Yeah, I mean, I think we're looking at one of the lowest equity risk premiums in the US that we've ever had in a market that's, even after the recent correction, not super cheap. A $2 trillion alternatives industry, 30,000 plus private companies that haven't been sold. It's hard to be, and oh yeah, by the way, like high yield and investment grade spreads, which are at, close to historic lows. So it's hard to look at that picture along with a high degree of sort of global macro uncertainty and be super excited about what the 10-year go-forward return picture looks like. That said, I've been wrong before, and I think we are constantly trying to coach our families to have pretty moderate expectations about what we can generate and to control what is in their control, which is how they spend. Because I think it's a really hard setup for outstanding returns. We do the best we can, and we've had a lot of extraordinary positive surprises, and the economy is strong. So I'm a pretty optimistic person, but the numbers right now are not super compelling on a midterm view, at least, for it being a incredibly high-performing environment.
I think that the boards are, at least my board, maybe, I don't think I'm unusual though, I think they feel like we're the boy that cried wolf, right? Because we've said, we say, we don't expect the same returns, things are getting more conservative, you should, please dial back expectations. And one of the people on my board said, we've been hearing that same line since your predecessor was here. Yeah. Are you guys just gaming? And I'm like, no, we're not gaming. When you think about the market and you think about what's happening right now, why would you expect things to be better than they were before? It's just nothing about what has happened in recent years sort of bodes well for performance getting better. So I think in general, our expectations are that for all of the traditional asset classes that we've invested in, we sort of believe that there's both return compression and probably alpha compression in both of those. So we believe that returns are coming down, and that in order to outperform, we're going to have to go out further, a little bit further on the risk curve, if that's what we want, and to try to find strategies that we haven't explored in the past and see if there's some opportunities in other places. You know, I remind everybody all the time that when, you know, Swenson came up with the endowment model, Yale's endowment was about $1.7 billion, and venture was a cottage industry. It is not a cottage industry anymore. And so we're going to have to find the next venture industry if that is a strategy that we're going to execute on. And I'm not sure it's clear yet. And I'm not sure if we've built our teams and the way we think about it around exploring totally new ideas. But I do think that that's what it's going to take in this environment. And don't ask me what that is, because I don't know. But I'm hoping someone smart tells me.
I think Kim's right. We've been saying since the end of 2008 that it's a new normal, that the returns should be lower, and we're 15 years into a bull market minus a couple of years of underperformance. And if you look at the private foundation space, we don't have any inflows. So we're paying out 5% of our capital every year, and on top of that, supporting on a platform that's relatively expensive. So if we don't earn returns of 8%, the model doesn't work. And so we need to find ways of making that return.
So I asked all of my panelists to come to this session with a question that they wanted to ask their fellow panelists. So let's do that. Carlos, you want to go first?
All right. So I've heard Kim mention before that one of her superpowers is managing the board. And Jenny,
You're not supposed to say it out loud. They're not supposed to know that's
yes,
my superpower. The superpower is tricking them.
Yes. I heard you say it at a conference, so I felt it was, but yes, that was perhaps a smaller room than this one. And so I'm curious, for either one of you, there are a couple of things, especially perhaps on the listening side. Sometimes it's about taking input and then reflecting that back. So to put you in a good spot, Kim, how do you listen to your board in a way that you can bring back that and same for you, Jenny, how do you take the input from your stakeholders so that that's reflected on the program going forward?
So I think for me, it's a couple of things. One, I think it is always keeping in mind that we're on the same team, right? Like, I don't have an adversarial relationship with my investment committee on my team. They care about the institution. I care about the institution. So we start out with, this is the strategy that we're going to execute, and this is the fundamental beliefs. Do we all agree, right? So as soon as we agree on what our strategy is and what our beliefs about the market is, then I can take every suggestion they make and run it down. Like, if they come up with an idea, we do some work on it, and then we say we've done the work and we like it or we don't like it. And sometimes we say it's inconsistent with the strategy that we agreed to. Sometimes we say we've done some work on that, and here are the things that we find concerning, and so we're not going to move forward. And we're building a portfolio that we believe that we can monitor and that we can feel confident about over long periods of time, not short periods of time. Because the board tends to have a different time frame. Oftentimes, the board are people who are in the industry, and they are these managers that we choose that we want to be more tactical, and so they're traders, and they think about things differently than we do, and we remind them that we're long-term investors. I think that if you start out with common belief systems about what your role is and what their role is, and you respect that, it starts there, and then it goes off really well after that.
Yeah, I would very much agree with the being on the same team framing. We've really tried, and I'd have a slightly different answer, I guess, for my board and my investment committee, but the deeper engagement is with the IC, and probably the more interesting answer. And I feel like I have this incredibly thoughtful investment committee, which luckily isn't too large. And the challenge I have is really wanting to bring them along for the ride when they're very busy. Because I value all of their opinion, and a lot of it is also just training my team to value their opinion. Like, these are not folks that are here to get in your way. They're folks that, have just tons of judgment and experience. And, if they're pointing out something you already know, it means pay double attention to it. And by the way, they may actually see something that you're not, and just have a huge level of humility around that. But then I think for us, we've really wanted to move away from thinking of them as a rubber stamp that sort of shows up at the end of the process, they don't actually have voting authority, into bringing them into our process to ensure that we're gleaning information from them at a time when we're still open to hearing feedback, which has meant actually asking more of them by asking them to opine on ideas substantially earlier in our process when their questions matter to us. Because I think the challenge is when they come in late, they're disengaged and we're disengaged, and I want high engagement, otherwise why are they there?
Right. And I also think that encouraging our teams to serve on investment committees and to serve on different boards, because then they appreciate that you can ask questions and be engaged and it not being an insult. It's to be cooperative. And I think it's easier once you've been in that seat to understand that.
Absolutely. Excellent. Thank you both.
Great. Choose who goes next, Carlos.
I'm happy to go. So I think we spent a tremendous amount of time underwriting managers and concepts and investments and teaching our team to do the same. And ultimately, a part of our job as leaders can be to let people go when it's not working, and a part of our job as portfolio managers can be to let relationships go. And I find it to be one of the most painful, challenging parts of the job, often a part of the job too where frankly, there's a lot of CYA risk. There's a lot of reasons to hold on to relationships. I would just love to know how you manage that, how you manage the firing process, and what insights you might have.
I think managing, it starts with the team. It's often so hard for the team because they feel like there's career risk to firing a manager that they put in the book. We've asked them to build a close relationship with these people, and I think that as appropriate, we want to be long-term investors. We don't want to be, we want to be partners with the managers we invest in. And so I think you have to start with first having agreement with the team on how we'll think about firing. So one of the things that we do is we have a heuristic where we have kill criteria. If anybody read Annie Duke's book, she talks about kill criteria. So we have kill criteria that we say if any of these things happen, then we will redeem unless somebody can explain why we should not, right? So we start with, if you violate one of these kill criteria, we're going to redeem. And then we've introduced something called STAB, right? Which STAB is why are we killing it? Why are we stabbing it? We're stabbing it for strategy, some team issue, an alignment issue, or a business issue. Those are it's one of those 4 reasons why we're going to kill a manager. And so when we talk to our managers along the way, we're also real clear with them about what our kill criteria is. It should not be a surprise. And we're telling them, well, when you do this thing, it feels like a strategy misalignment. And so like one of the things is somebody will say, a kill criteria is that the fund doubles in size. Okay, is that because you're concerned about the strategy, or is that because you're concerned about alignment? Because they might not be the same reason. And so there might be, when it all comes down to it, you may be like, the fund size grew, but it doesn't violate the thing we thought was going to be a problem, and so we can keep going. But if you start out before there's a problem saying to a manager, these are the things that we're concerned about. We underwrote this. We really like you guys, but this is the things we're going to be watching. And then later on, it happens, and we can have a dialogue about that. It makes it a little easier because it's not that what you're deciding to do is wrong. It's not that we're not being good partners, but you fit a role in our portfolio, and now you don't anymore because you've decided to be something different, and you get to run your organization how you want to run your organization, and you get to be who you want to be. But I'm constructing a portfolio that requires certain things, and when you violate those things, which I'm not saying it's bad or good, it just doesn't fit, then we can part as friends, right? Like you just made a different decision and I don't have a need for that thing. And so that's how we kind of addressed it. It doesn't make it easier, right? It's still painful to do because you do oftentimes really build strong relationships with these people, and they're smart, and you want to be long-term partners, but ultimately, I oftentimes say, which is kind of a cop-out, but I think it's true most of the time, if this was my money, I could do this, but I'm a fiduciary for Columbia University, and I have to make a different decision.
Yeah.
So it's a great question. I think it's such an art, either when I used to follow stocks to know when to sell the stock, it was so much easier to figure out when to buy it than when to exit. And so we started with a watch list. So we, as a team, we debate and discuss, and so we have asset class specialists, but everybody owns the whole portfolio. So we'll come together and have these conversations at a portfolio level as a team every Tuesday, but then in a deeper dive at least 3 times a year. And we have a watch list, and people will get into the watch list based on performance, team changes, business concerns, or even reputational risks. And so those are the main things that we will discuss. And we have found too that some managers will get on that watch list for team changes or performance, and sometimes those go together. And we have found that some of those, we had a manager, best performing manager the last 2 years in public equities was a manager that was on that watch list at some point. And we had some very open, frank conversations with that manager. I think we still have a great relationship with them, but they obviously knew there was a problem. We knew there was a problem, but in a way we were still on the same team. And they were able to make the appropriate changes, and we're seeing the results of that. So I think that those will be the drivers for us to make the decision. And generally, unless there's something urgent, we do take some time in making that decision. And we also have passed perhaps in one private equity fund and then gone back at the next one as some of our concerns alleviated. So, or we reduce capital on liquid managers and eventually either fully redeemed or return some of that capital based on our concerns.
Yeah.
So we clearly will have failed as a panel if we don't talk about AI at least once. So my question is, we are all both constructing portfolios, but also building teams that can grow and become additive. How are you thinking about what you need to do for your analysts who are going to have a lot of the things that we previously did now being done by AI? How are you going to teach them to be good managing directors, or even good associates or good directors on their road to managing directors? And are you hiring something different than you were hiring before?
I think we're at an early stage in this journey, that it's evolving so quickly that it scares me and excites me. And we had, as part of our team offsite this year, we had a big conversation about AI and both the opportunities and the risks. And what I said to the team, sort of coming back to first principles, is we have to use this to make us smarter and think deeper, not just lazier. And I haven't hired differently yet, because I think ultimately we're sort of such an overused term in the investment world, but we're trying to hire athletes. We're trying to hire thinkers and investors, like individuals who love the work. And if they love the work, then AI becomes this really exciting tool where they use it to go deeper. I had, one of my team members the other day used Cloud for Excel to replicate a model that we wanted to sort of run some scenario analyses, and a manager wouldn't give us their model, and he was able to replicate the model very quickly and then use it to run really interesting scenarios. That is a way where it made him smarter. It allowed him to do work he couldn't do otherwise. What I also see is team members who are short on time using it to write memos. Okay, I love a memo that's better written, because I don't think people teach writing anymore, but all the cynicism gets sucked out of the memo and it turns into a used car salesman sort of pitch. And it's so obvious. And I'll just call it out in front of the team and say, okay, we know ChatGPT wrote this. I know you did the work. I need your cynicism to come back, so do better. Go back, and it's fine to sort of use it as a tool, but that's what it is. It's a tool, and it has to be placed in its appropriate box. But I think we're at the very early stages of this phenomenon, and I think it's only going to get harder.
Yeah.
So, Kim, you're also doing pretty interesting things, so I'll go quick so you can share some of the things you're doing on that front. I think as CIO, you're doing two things really, which is managing to the impact that's been mandated by the board, and then managing the people that deliver on that impact. And so the commitment I have to everybody on my team is that there's an individual employee value proposition for every person on the team. And I think at this point now, AI is part of that development and value proposition for the team. And so you can help grow your people on that skill set, at the same time making the investment office overall a better performing investment office. So this year we have our cross-functional team that's working on the development of AI policies and exercises that we can do. And we have a couple of tools that are on the roadmap to be deployed as early as this week. So we're pretty excited about the synergy of people getting better and adding to our toolkit over this year.
So we're out of time.
Yeah.
So if you want to hear about my AI strategy, you can find me in the hallway.
We could talk for hours. What a wonderful panel. Before we round up, we'll see who owned which facts. Profiled in a university newspaper at 2 years old. Carlos. Yep. Set up a reading book club with their daughter. The aim of reading 20 books a year, but actually got to 22 a year. Kim. And lived with a Zulu family in South Africa with a woman who grew up in an ashram, in Gandhi's ashram in India, was Jenny. So we've got amazing investors, but amazing people, amazing life histories as well. Thank you guys so much. Please join me in a round of applause.